if they have a short sale scenario, and I think Sean's a great resource for that. So I'm going to turn it over to Sean right now. And as people come in, Sean, we'll just catch them up.
Sure.
Okay, thank you.
Yeah, not a problem. My name is Sean Wilder. Our company's Loss Mit Services. We're a short sale negotiation company in Connecticut. So we're hired by real estate agencies to do the short sale negotiations for the clients that they have that need a short sale. And we're going to get into how that works when we get involved, all that kind of stuff. But we're also going to go over a lot of kind of the background if you're being presented with a homeowner who has a trouble making their mortgage payment, they're looking for assistance to get out of the property, what their options are, what they're facing, that type of thing, that would lead them up to, considering doing a short sale. So let me start sharing my screen here. Okay. I can expand this out so I can see it a little bit better.
Is everyone able to see the screen? Maybe just chat yes in the chat box. Okay, good.
Cool. Great. Okay. So again, my name is Sean Wilder. Short sale negotiation training is what we're going to be talking about. And really from the agent's perspective, if you're going to be working with a company like ours, I'm going to go over some of the stuff that we do that if you're trying to work on a short sale your own, so you can kind of get a grasp of all that we have to do. But I'm a licensed debt negotiator here in Connecticut, specifically for short sale negotiations. If you didn't know, any third party like us that's hired and paid for short sale negotiations has to be licensed through the Department of Banking as a debt negotiation company. I also have to have a mortgage loan origination license in order to carry the debt negotiation license. It's kind of a twofold license. I'm also a licensed real estate agent, as is my partner. We don't practice as agents. We haven't in over a decade, but we do still maintain our license. But that's how we got into short sales to begin with, is as listing agents. And we've been negotiating short sales since 2008. We close about 200 short sales or so every year. So our short sales still relevant at this point. And this slide's kind of left over a little bit from before COVID, because I think most people recognize that we're going to see an onslaught of foreclosures once the foreclosure moratoriums expire. But even before that, Connecticut was still pretty far behind most of the country when it comes to how low our foreclosures had gotten. They're still much lower than they were at the peak, but in 2019, you had an average of 500 new foreclosure filings in Connecticut every single month. And for the first quarter of 2020, before the courts closed down for COVID, we were actually 62% higher in foreclosure filings than we were in 2019 for the same period of time. So foreclosures were already ramping up a little bit more than they were the prior year before we had anything related to COVID. But COVID, unfortunately, is going to cause a whole lot of homeowners to be facing foreclosure when their forbearances expire. There was a height of like 5 million forbearances at one time. I think they're down to about 2 million forbearances nationwide right now that are still active. And they've been extending. Now they're extended through June, how long you can be in some of the forbearance programs, whether it be a Fannie Mae, Freddie Mac, FHA, they each have their own guidelines. And then if it's a local bank, they have their own. A lot of them have followed suit with the federal programs, but they're not required to. But when those programs were given, the homeowner just had to ask, say, hey, I have a problem. It's related to COVID. I heard there's a forbearance, and they got approved for a forbearance. Initially could be 3 months or so that they didn't need to make payments. Since then, they've been able to ask for several extensions. It's going on now till June. It'd be like almost a year and a half if they got it right at the beginning back in March of last year. So there's a lot of people that got those. They didn't have to do anything in order to get them. But when they expire, if they don't just have the money to make up the missed payments that they haven't made and start making their regular mortgage payment, then they have to apply with the bank for assistance. And we're going to go through the different kind of options that they have. But they have to submit a full application package. There's a form that they have to fill out with income and expense information. They have to supply a month of pay stubs, a couple months of bank statements, a couple of years of tax returns. And they have to prove to the bank what their current income and expenses are. And then the bank uses that information to determine what can they do. Can they approve just a repayment plan, because this person can afford their regular mortgage payment plus a little bit extra each month. And then eventually over time, they'll make up, with that little bit of extra each month, what's been missed, or they approve for a loan mod where they modify the loan or they defer to payments. But they have to go through that application process. And a lot of people fail to get through the application process and get the bank everything that the bank needs. The banks do a horrible job of explaining what's required and getting back to homeowners. Homeowners oftentimes don't realize that they really need to take the driver's seat and constantly be calling the bank every few days for updates to make sure they're not missing stuff and that type of thing. So because of that, we're going to see a lot of people end up in foreclosure who maybe could have qualified for some kind of assistance to get back on track. But then there's the people that have either lost jobs, lost income, lost businesses, who are not going to be able to get back on track, and they're going to be facing foreclosure and they're going to have to sell. Connecticut, until the last year, had seen next to no appreciation for most of the states since we hit the bottom of the real estate market in about 2012. And it doesn't take very long with missed payments to get pretty far behind dollars wise. If you say your principal balance was 200,000 and you haven't made a year's worth of payments, you're probably getting close to 220 or more that you owe between the missed payments and if the bank's paid your taxes, real estate taxes, and that type of thing. It's all being added to what you owe. So, in that scenario, that's like 10% higher than what you owed a year ago. Well, if the values went up 20%, that means you only have 10% increase. If you were, less than 10% equity to begin with, you're underwater. And the farther behind they get, the worse that's going to get. The vast majority of sales that happened after the financial crisis started were first-time home buyers with low down payment loans. So they've got next to no equity to begin with. Some of them are 100% financing. They had no equity when they purchased, had no appreciation. You pay down very little on your loan in the first 10 years. And then you find yourself a year behind on payments. They're back to probably what they owed when they first borrowed it. So it's not, there's a lot in Connecticut, especially because we didn't see appreciation for many years. There's a lot of people that were borderline, and then once they fall behind, they're going to be negative. Never mind the ones that were negative to begin with. Many homeowners, when it comes to a short sale, don't seek help from a realtor because they don't think a realtor can help them. If they've never heard of a short sale, which is pretty common in the normal public, most real estate people have heard of a short sale. Even if you're new to the business, don't fully understand what it is, you've heard of it. Homeowners in the general public, that's not the case. And I think a lot of us in real estate kind of lose sight of the fact that it's not common knowledge. So if a homeowner knows that they can't make their mortgage payment, and they know that their house isn't worth what they owe because they've looked up their value on Zillow or something like that, and they don't know what a short sale is, then they're not going to reach out to a realtor because they don't think a realtor can help them because they don't have the money to bring to closing to make up the shortfall. So having the information out there for agents to understand what the process is so that they can, even in their own marketing materials and stuff like that, especially when numbers are higher for foreclosure, include that, hey, even if you're underwater, we can help. Even if you're facing foreclosure, if you're behind on your payments, we still may be able to help you. So that people that see those messages and go, hey, I didn't think a realtor could help me in this situation. Let me call and find out, what are my options there? Oftentimes, when I speak with a homeowner, the agent or the attorney or whoever it is that gave them my name was the first person to bring up short sale. If they had known about it, they would have been looking at it sooner. And I've had people that have had problems for years. They tried renting the property because they couldn't sell it years in the past. If they had known about a short sale then, they would have just done it. So what are the seller's options to avoid foreclosure? So if they're behind on the payments, they can reinstate the loan, which is they just ask the bank for a reinstatement amount. If they pay that amount to the penny, then come the first of the next month, they're just due for the regular normal monthly mortgage payment. So that's paying all of what they're behind all at once. A repayment plan is where the bank agrees that they're going to go back to making the regular payment plus a little bit each month until the shortfall is paid back, the amount that the bank had, not been paid. So let's just say your, payment's $1,000 a month and you miss a year, and then, or say it's $1,000 a month, or let's say it's $1,200 a month and you miss one payment. They could say, we'll make your regular payment of $1,200 plus an extra $100 a month for the next 12 months. That's going to pay back the $1,200 that you missed. That's an example of a repayment. But you can't just send them a 1 month payment with an extra $100 and say you're good. It has to be agreed by the bank. Otherwise, you're still considered to be delinquent. They're still going to move forward with foreclosure because you're still behind. Or they're going to move forward with collections and eventually foreclosure because you're still behind. You have forbearance plan, specifically COVID-19 forbearances is a specific one, where the bank agrees that the homeowner doesn't have to make a mortgage payment for a certain period of time, or COVID-19 has been that you don't have to make any payment. Traditionally, forbearances didn't necessarily mean 100% no payments. It could be, okay, you only have to make 50% payment for the next 6 months, and then we'll reevaluate. And most commonly, they were used for unemployment because they can't modify the loan and figure out how to make the payment affordable for a homeowner who's got no income, or they're only on unemployment, which is not a permanent source of income. They know it's going to end. So it's supposed to be a stopgap to see if your situation improves. And then when the situation improves, hopefully by the time the forbearance expires, then they reevaluate based on your new income situation to see what they can do with the payments that were missed to get you back on track. And that's when they're looking again at reinstating the loan, repayment, loan mod, those types of things. But a forbearance is an informal agreement, but it is an agreement with the lender for you not to make payments for a certain period of time, at the end of which they're hoping that they can do some kind of a more permanent workout to get you back on track. The most common permanent workout is a loan modification. During the financial crisis, we had the Home Affordable Modification Program, which created a uniform set of paperwork and guidelines for eligibility for loan modifications, and pretty much everyone used that program. FHA, Fannie Mae, Freddie Mac, most of the private conventional loans, because they were with serviced by banks that had gotten government bailouts and therefore had to, agree to this particular program. That program expired at the end of 2016. So since then, FHA's got their own rules, Fannie and Freddie have their own rules, and then every bank that services something else, private conventional loan, home equity line of credit, whatever, has their own rules, their own paperwork, their own application, etc. So it's not uniform at all. But the loan modification is where they permanently modify the loan to change the terms. Normally, when they give you an agreement saying we can modify your payment, they start it with 3 trial payments. If the homeowner can make those 3 trial payments, then they send them the paperwork to permanently modify the loan. Its documentation has to be signed and notarized and sent back to the bank. And then they record a modification of the mortgage on the land records. And oftentimes it's increasing the amount of the original loan amount that it showed on the original loan, depending on how far behind the person has been. But that permanently modifies the loan. So they can extend the loan out. So say your loan was 5 years old and it was a 30-year loan and there's only 25 years left. They can re-amortize it for 30 years. If nothing else changed and your balance hadn't changed, extending it to 5 years longer would reduce your payment a little bit. They can modify the interest rate. So if the interest rate now is lower than it was when you got the loan, then that also could reduce the monthly payment. They can also, for certain types of loans, make the payment not 30 years, but 40 years, which would reduce the payment, the monthly payment. And all they're looking at is what can we do to reduce the monthly payment to a level that the homeowner can afford. One option I don't have on here that they did add for COVID is a deferral, where they can just take the payments that were missed and defer them to the end. So let's say in that example, you had 25 years left on your payments and you missed 5 payments. Well, now you'd have 25 years and 5 months worth of payments left to make, and you'd go back to making your regular monthly mortgage payment. Unfortunately, they have, at least not yet, and we don't know whether they're going to, instituted any kind of streamlined option where you can request the deferral and not have to prove that you can't afford some other option, which would make the cleanup of this after the fact much smoother for people that could go back to making the regular payment. So far, you still have to do the full application with all the paperwork, pay stubs, bank statements, tax returns, and the bank's got to review for everything, and the deferment is not the first option that they're going to look at. It's really the last one. So those are all what's called home retention options for the homeowner to keep the home. Then you get into liquidation options, which would be short sale or deed in lieu of foreclosure. I'll skip short sale because we're going to get further into that. Deed in lieu of foreclosure is where the homeowner and the bank have an agreement where the homeowner is just going to sign the deed to the property over to the bank, and the bank agrees that that's it, they're off the hook, they can move on. And if there aren't any other liens on title, the bank now owns the property. They can just release their own mortgage lien and the property is free and clear of all liens, and they can just move forward and sell it as a bank-owned property. Typically for the homeowner, that's going to be a little less impactful on their credit. Also eliminates the possibility of a deficiency judgment, which could come after a foreclosure. So they know that they're done with this situation. Where that becomes more complicated is if there's other liens on title, the bank typically will not accept a deed in lieu because they need clean title to the property in order to be able to resell it. So if there's junior mortgages or other liens, they're typically telling the homeowner, you got to get rid of those somehow, otherwise we can't do a deed in lieu. Where in a short sale, you're typically negotiating all of those liens because there's money coming to the table, from the offer. You've got something to offer these other liens. In a deed in lieu, you may not have any money, especially if the homeowner's got no money at that point. But that's what a deed in lieu of foreclosure is. Most banks will require the homeowner have tried to sell the property themselves for at least 90 days before they'll consider a deed in lieu, even if it was marketed for a short sale. So regular sale or short sale, they have to try to sell it themselves for a certain period of time first, because the bank would rather just get money from a closing than have to take the property, manage it, and resell it. So then we've got bankruptcy on here. So bankruptcy does not necessarily avoid a foreclosure. There's two different types of bankruptcy. There's Chapter 13, which is reorganization of debt, where you have to repay a lot of your debts, but they stop charging interest and they can put you on a payment plan for up to 5 years. If you don't have enough money income to be able to afford that, then you may qualify for Chapter 7 bankruptcy, which is full liquidation, where you wipe out all the debts, you don't owe them at all anymore, come out the side basically free and clear, and you can move on. You can include mortgages in that. However, there's two parts to your mortgage. There's the note, which is your personal promise to repay the money. And then there's the mortgage, which is the document that gets recorded on the land records that says this house is collateral for repayment of that note. You can include the note in bankruptcy, not the mortgage. So the house is still collateral. Bank's still going to foreclose on it even after a bankruptcy if the homeowner's not making payments or doesn't work out some other kind of workout, either a loan mod or they do a short sale if they need to, or just sell it and pay the loan off. If they're not paying, even though they've done bankruptcy, the bank's going to continue to move forward with foreclosure. They just can't go after the homeowner for any kind of deficiency or any money at that point because the homeowner's already done bankruptcy. So the bankruptcy can delay a foreclosure, and sometimes it's a valuable tool for that, depending on the homeowner's circumstances, but it's not going to prevent a foreclosure from happening. And then we've got foreclosure. Foreclosure is involuntary repossession of the property, where the bank's, prying it out of the homeowner's cold dead hands per se. And typically in that scenario, or very common in that scenario, the house is not in the greatest condition. Homeowner may have trashed it on the way out, may have abandoned it many, many months earlier, so it's been vacant for quite a while and not maintained. So the reason lenders oftentimes will entertain a deed in lieu is because they're usually going to get the property back sooner and in better condition than if they have to foreclose. So there's a benefit for the bank, and there's also a benefit for the homeowner in that scenario. So what is a short sale? Short sale is when we negotiate with the lender to accept less than what they're owed. If the sales price of the property is not enough to cover all of the debts associated with the property and the closing costs, then you're potentially looking at a short sale. So that means any mortgages that are owed, any other kind of liens that have been attached to the property, and then the closing costs associated with the sale. Commission, conveyance taxes, closing attorney's fees, recording charges, any other kind of prorated charges for water and sewer, homeowners association dues, and then payoffs to any other liens. Oftentimes, homeowners that are behind on their mortgage have been behind on other debts, credit cards, medical bills, etc. And they may have gotten far enough along where they've sued them, they've won a judgment in collection court, still haven't been paid, and since this person has real estate, they've put a judgment lien on the property. So it's another lien that we have to figure out how to get released or paid in order to be able to sell the property and give a buyer clean title. So why would a seller do a short sale? So short sales can potentially reduce the credit score impact for a seller. A short sale is negative on your credit because you're not paying the loan off in full as originally agreed. So it's a negative. It's called settled for less than full payoff. That's how it's reported to the credit bureaus. The credit bureaus tell us, and they don't openly disclose their exact formulas, but they say that they don't score a short sale differently than a deed in lieu or differently than a foreclosure. However, if you're able to do something like a short sale or a deed in lieu of foreclosure in a shorter amount of time than it would have taken the bank to foreclose, you're going to have less of a negative hit on your credit because you're going to have less missed mortgage payments reported to the credit. Every month they report to your credit. So the longer you're behind, you're 30 days late, then 60, then 90, then 120. And then usually after that, it's just 120 plus, 120 plus, 120 plus. Every single month, it's whacking your credit score and bringing it down. So say you're 4 payments behind on your payment on your mortgage, and then you do a short sale. Well, it shows 4 payments behind, closes as a short sale. In Connecticut, you're usually looking at 8 months bare minimum for a foreclosure to be completed from the time you missed your first payment. Right now, it's going to be way longer than that because the courts are far behind due to COVID shutdowns. So let's just use the 8 months though. Instead of being 4 months behind, you're 8 months behind, and then it closes as a foreclosure. Credit bureaus say that that foreclosure is not going to be scored any differently than a short sale, but you had 4 more months of being behind on your payment that was recorded to your credit. So that's more times than your credit score has been dropped, 4 more months that your credit score is dropped. So the short sale by itself doesn't have less of a credit impact just by doing a short sale. If you're doing a short sale this month and you just got a foreclosure date postponed because it was going to happen later this month, that person's not going to have any better credit doing the short sale than they would have if they had gotten foreclosed on, because they've had the same number of missed mortgage payments. The bank was about to foreclose anyway. The time's already happened. The credit impact's already happened. But there are other benefits, specifically waiver of the deficiency balance. So a deficiency is the difference between what the bank gets and what they were owed. So if it goes to foreclosure and they're owed 200 grand and it's only worth $150,000, there's a $50,000 deficiency. In Connecticut, they have the right to pursue a deficiency judgment, and those judgments are good for 20 years, where the bank can still pursue the homeowner for that other $50,000 after they've already foreclosed on the property. The homeowner, if the bank decides to pursue it and the homeowner doesn't have the ability to pay, they're looking at probably having to file bankruptcy in order to eliminate that deficiency balance and get it wiped out. In a short sale, the vast majority of the time, like 99% of the time, the bank agrees in writing to waive their right to collect the deficiency balance in the approval letter. So when you go to closing, let's say in that same example, house sold for $150,000 as a short sale, or the bank got $150,000 from the sale of the short sale, or owed $200,000. So it's a $50,000 deficiency, but they've given the homeowner in writing that that's being forgiven. They're not coming after them for it. That's all there is to it. They don't owe the money anymore. So they're getting that in writing. That's, in my opinion, the biggest benefit for a homeowner to do a short sale is knowing that once they close, they're done. They can move on with their life. There's no additional, monkey that's going to climb on their back at some point in the future. No cloud over their head, that type of thing. Another potential benefit is a relocation check, which is actually where they're allowed to get a little bit of money from the sale at closing as an incentive for having done the short sale. This is much less common these days than it used to be. Under the Home Affordable Program, at the end of the program in the last few years, they were approving $10,000 to the homeowner for a relocation check if the owner occupied the property and had to move for the sale to be completed. And if the property was rented, they'd give $10,000 to a tenant that had to move for the sale to be completed. That's all expired. That's gone away. There's 1 or 2 banks that'll still occasionally, you'll be able to get 10 grand out of them, but it's pretty uncommon. The most common number these days is $3,000, and it's not very common that it gets approved. The homeowner has to be living in the property and need to move in order to complete the sale in order to even be eligible for it. And even then, their financial review determines whether the bank's going to offer that to them or not. So I don't typically bring this up with homeowners as like a carrot to get them to do a short sale. I'm not trying to convince them to do anything. Just giving them all the facts so they can make their decision. I don't bring this up. I've had agents in the past, at least in the eyes of the homeowner, promise them that they were going to get $3,000 at closing. Agent probably did not promise them that, probably just said, hey, you might be able to get a $3,000 incentive. But all the homeowners heard or thought throughout the process was, I'm getting $3 grand and I need that $3 grand and I've planned on getting that $3 grand. And then they don't get approved for it. And now they're ticked off like crazy at everybody involved. Even though they're avoiding foreclosure, the bank, they're not going to owe the bank any money anymore. They can move on with their life. All they really care about is they're not getting the $3 grand somebody promised them, or that they perceive somebody promised them. So I don't bring it up. If the homeowner has heard about it, seen it on the internet or whatever, once I find out what kind of loan they have, and I know specifically which guidelines apply to them being reviewed for an incentive, then I'll go over those guidelines with them, make sure that it's clear that there's no guarantee they're going to get approved for it, that we always request it, whether the homeowner asked about it or not. We're always trying to get it for them. But until we have gotten to the end of the negotiations, we won't know whether it's approved or not. But that is another potential benefit for the homeowner. They're typically able to qualify for another mortgage sooner than if they had gotten foreclosed. Common time frame that you'll see is if you're 3 years, 36 months from a short sale, the short sale itself no longer disqualifies you for getting another mortgage. A deed in lieu, oftentimes that moves to 48 months. And for a foreclosure, it can be 5 to 7 years. Now, some of that's changing because we have non-QM loans that have come into the market over the last couple of years, non-qualified mortgages that are more, they when you initially hear about what their guidelines are, you think, hey, those are predatory loans from back in the day. But they still have to prove that the homeowner has the ability to make the repayment, which they didn't have to do back in the day. They just based it on collateral in the property. But there are loans, they're higher interest. You typically are not getting low down payment. So you do have to bring 20% down in order to get them. But you can potentially do it in less time. There are literally some 1 day out of bankruptcy, 1 day out of foreclosure, you can qualify for another mortgage, but you gotta have the money and show the ability to make the payment. But excluding those types of loans, a short sale, you're typically going to qualify for a mortgage sooner, or at least the short sale itself is not going to disqualify you for a less period of time. You still got to show an ability to make the payment. Credit score has got to be within the lending criteria, all those things. But an additional criteria that lending guidelines have are derogatory entries on your credit: short sale, deed in lieu, foreclosure, bankruptcy, and there's exclusionary periods of time. So the worse the scenario, the longer you don't qualify, and foreclosure would be the worst because it's specifically bad derogatory information on a prior mortgage. If they do a short sale, they're going to avoid the foreclosure, so that's not going to show on the credit. So if they did a short sale, like I talked about earlier, and there are 4 payments behind, they'd show 4 missed payments, and then it would show settled for less than full payoff. It would not say foreclosure. It would not say involuntary repossession. Also, a foreclosure shows in 2 separate sections of your credit report. It shows as being reported by the bank, and then it also shows in the public records section as a lawsuit and a foreclosure. If you've done a short sale, nothing shows in the public records section because there was no foreclosure. It just shows on that one line where the mortgage was. And the big one, again, they're avoiding a deficiency judgment. Now, income taxes are a concern for homeowners, and I see this one misunderstood all the time. So the IRS policy is if you have someone loan you money and you have to repay it, that's not income. That was a loan because you have to pay it back. If they later say you don't have to pay us back, now the IRS considers that money to have been income. Doesn't matter what the loan was for, what it was used for. Doesn't matter that it was a mortgage. They gave you money. Now they say you don't have to pay it back. That's ordinary income. You owe taxes on it. Now, it doesn't matter how the debt's forgiven. So if you do a short sale and they forgive debt, if you a deed in lieu and they forgive debt, if they foreclose and decide not to pursue the deficiency and they write it off, that's forgiven debt. So in any of those scenarios, there's a possibility the homeowner is going to owe taxes. They can't avoid the possibility of owing taxes by letting the property go to foreclosure. In fact, if it goes to foreclosure, the best case scenario is that they might owe taxes. Because if they don't, that means the bank's pursuing the money, all of it. So they're coming after all of the loss. If they decide not to come after the loss, then they're going to report it to the IRS on a 1099-C for cancellation of debt. And the homeowner is going to have to determine, they're going to have to file special paperwork or schedules with their tax return to determine whether they qualify for an exemption not to owe taxes on that. Most homeowners that do a short sale or get foreclosed on qualify for one of a couple exemptions to not owe taxes. But it's not automatic. If it was an investment property, if the homeowner's got significant amount of other assets like retirement savings or they own other property with equity, they very well may owe taxes on the amount of the debt forgiveness. Now, if the deficiency was $50,000, the taxes are far less than $50,000 if they forgive the debt versus the bank coming after you for the 50 grand. But these are things we want to make sure the homeowner's aware of, bring to their attention, maybe have them talk to their accountant to see if it looks like they qualify for one of the exemptions where they wouldn't owe taxes anyway, so that they know what their stance is. But the best case scenario is the debt's forgiven, but that scenario creates the possibility that there may be taxes. It still would be far less than the amount of the debt that was owed. But that's something we want to bring up. And oftentimes the misconception that I see, the homeowners are like, oh, I heard I'm going to owe taxes if I do a short sale, so I'm just going to let it go to foreclosure. And the big takeaway there is that doesn't get rid of the tax possibility. And in fact, if the debt is forgiven, taxes would probably be higher because by the time the bank forecloses, the amount that they're forgiving and the loss is higher with all the interest and fees and whatnot that's been accruing. So why do banks do short sales? Why would they accept a short sale? Why are they voluntarily going to forgive debt? So for them, it's loss mitigation. They're trying to mitigate their loss. Statistics show that they're typically going to lose less money if they do a short sale than if they foreclose. But they're still comparing the two when they're deciding on a short sale. So they are comparing the offer that is being submitted to them to what they think they would recoup if they foreclosed and sold the property themselves. Typically, they're going to order an appraisal or a broker's price opinion. and they're going to use that number to determine what their opinion of current market value is, and that's what they're going to compare the offer to. They're not typically comparing the offer to what's owed by the homeowner. They're comparing it to what they think the current value of the property is. Short sales typically lose them less money. They avoid foreclosure and the amount of time that takes. They avoid REO, having to take the property and, as a real estate owned asset, having to maintain it while they try to sell it, pay the taxes and insurance, et cetera, while they own it. So again, statistically, they're going to lose less money if they do a short sale, but they're only going to approve a short sale if they believe the property is selling at or very close to the current market value of the property, because that's what they think they're going to get when they go foreclose and sell it themselves. Typically, they're still going to get something less, but that's not how they look at it. But for them, it's just a financial decision. They don't care about the homeowner. They don't care about the circumstances. They don't care about the agents involved. They don't care about the buyer. All they care about is dollars and cents for themselves, unfortunately. So who qualifies for a short sale? So the bank must foresee that they're going to take a loss, meaning if the homeowner is current on their payments and they submit a financial application to the bank that shows that they make more money per month than they have in expenses, the bank does not foresee a loss. They have no reason to believe that this homeowner can't afford their mortgage payments. So why are they going to voluntarily forgive money? Just because the homeowner wants to move, they don't care. All they care about is the dollars and cents. So they want to see that the homeowner is in, or they need to see that the homeowner is in a financial position where they're not able to afford the mortgage payment anymore. Doesn't mean they have to be late on their payments, although for some types of loans, they do have to be later. They're never going to get approved, but that's not an across the board situation. It's specific to the type of mortgage. But they do have to have more average expenses per month than they have average take home pay. That's the number one thing that the bank cares about. They don't care about the value of the property until they see that the homeowner has a financial hardship and that they actually qualify to do a short sale. So the biggest part of the package that we have to send the bank has to do with all the homeowner's financial information. Usually it's 30 days of pay stubs, 60 to 90 days of bank statements, 2 years of tax returns, an income and expense form, a hardship letter. And depending on the circumstances, there can be a lot of other information. If they're self-employed, profit and loss statement, all kinds of stuff. We have to make the case, prove to the bank that the homeowner can't afford the mortgage payment and therefore is eligible for a short sale. Now the bank cares about what the value is, because if the homeowner can't afford the mortgage payment, then the bank knows if they do nothing, they're going to end up having to foreclose. And now they're looking at, well, what's the alternative to foreclosure? You have a short sale offer. What are we getting? How much is the offer? What are we going to get from that? How does that compare to what we think we would get if we foreclosed? So homeowner needs enough financial inability to pay the mortgage, and they basically has to be in a must sell situation. Just wanting to sell and the property not being worth what they owe is not enough to qualify for a short sale. There must be a financial hardship. One exception to that, reverse mortgages. Reverse mortgages are a totally different game. Doesn't matter what the homeowner's financial situation is on a reverse mortgage. So just everything else, what I just said applies. Reverse mortgages are their own animal. They're a non-recourse loan. Homeowner's not personally responsible to pay them the money. The house is just collateral for repayment. So a totally different set of guidelines. We do reverse mortgage short sales quite a bit. So when to get us involved. So again, we're a short sale negotiation company. We're hired by the real estate agency to assist the client. We only get paid if the deal closes, just like everybody else only gets paid if the deal closes. Our number one aim is to get the homeowner in the best financial position that they can be in at the end of the transaction. Number two is to get the agents paid. Number three is to hopefully get paid ourselves. We're hired by the real estate agency. Our fee is 1% of the sales price. We only get paid if it closes. Typically, an agent's going to ask for a 6% commission. We have to negotiate with the bank to pay the commission as well as all the other seller's closing costs from the sales proceeds. So like the closing attorney, conveyance taxes, et cetera. Preferably, if you're going to be hiring us, get us involved before there's an offer. There's a lot of background research that we got to get out of the way, and we're going to go over that in a slide that's coming up. And ideally, we get that all out of the way. We have all the answers to everything. We know exactly what's going on before you have a buyer either asking questions or presenting you with an offer, and you don't know what should we do with this offer. And then you're asking me for information that I don't have all the answers that I need to be able to best answer for you. So ideally, get us involved. It takes about a week for us to get all the answers that we need after we get an initial intake packet from the homeowner, which is the bare minimum information that we need to figure out what's going on with them and then get authorization to send to the mortgage companies so we can get payoffs. We do some title research, et cetera. We're going to go over that in a minute. As soon as you know that it needs a short sale, give us a call, get us involved. For you, it's an easy sell to the homeowner. You know, hey, we're going to get an expert involved that all they do is short sales. They work with us, part of our team. We're going to get the situation taken care of for you, and there's no cost to use the homeowner. So even if the numbers are close, if you're like, if we get like the top of the market, we might not need a short sale, but you really don't think this house is going to sell at the top of the market, probably best to give us a call. We can at least get that initial research done. If you end up getting an offer where it doesn't need a short sale, there's no cost for that. But if you do get an offer, even though you're listed at a higher price and it does need a short sale, we've already got all the answers that we need to answer everybody's questions, and be able to advise, what the situation is going to look like, what the time frame is going to be like, if there's any issues with the offer as far as terms that we know the lender wouldn't accept, those types of things. We've already gotten those questions answered. If you've had it listed for a while and you're reducing the price and now the homeowner says, hey, if we reduce again, I'm not going to have the money, then that's the time, to get us involved. So things that we investigate at the start. These are also things that if you're trying to do your short sale yourself, you really need to get a handle on all of this information. So a lot of stuff here over and above what a real estate agent would normally do for any other sale. So we have to determine who's on title. It's not uncommon for us to have a seller who's not the only person on the deed, like a divorce situation, or somebody passed away and probate hasn't been done. But we need to know who's on title. I mean, you need to know that because you need to know who's got to sign the listing agreement, who's got to sign the sales contract. And then we're going to need to know who's on the mortgage. Is it the same as who's on the title? Typically, you have one seller, they're the only one who's ever been on title, they're the only one on the mortgage. If you have a husband and wife and they were both borrowers on the loan and they're both on the mortgage, they're both on title. But it's also not uncommon for only one of them have to been a borrower. If the other one was a stay-at-home parent and they didn't have a job, they may not have included them in the mortgage application. So only one of them is on title. And then we have some unique scenarios where, say, the husband's the one who was the borrower on the loan. Now they're divorced, but the wife got the house in the divorce. He's been quit claimed off of title. In that scenario, the person who's on the mortgage is not the same as the person who's on title. The bank's going to ask all kinds of questions about that, because they're typically looking for their borrower to be the seller of the property when it's a short sale. If that's not the case, it's confusing to them. They're going to ask a lot of questions and they may have issues. So we want to figure out if we have any of those issues at the beginning. Never mind the fact that we need to know who needs to sign paperwork. When we're contacting the bank, whoever the borrower on the loan is who has to sign an authorization. So in that scenario, and I've had this where, the ex-husband was the borrower on the loan, they're divorced. The ex-wife's the only one who's on title now. She's the one who's coming to you to sell the property, but she's been making the mortgage payment, since the divorce. She can't sign a third-party authorization for us to send to the mortgage company. Mortgage company won't accept it. She's not the borrower on the loan. It's not her privacy that they need to protect. It's his. So even though he's not on the deed anymore, he needs to be 100% involved in this transaction because it's his financials the bank cares about. The divorce does play some into that scenario, but his is the one whose paperwork they're going to ask for. His signature is the one they're going to need to see on authorization paperwork and that type of stuff. So we want to figure these things out at the beginning. So then who's the mortgage servicer? The mortgage servicer is the bank, the person, the party that the homeowner gets the mortgage statement from. They may or may not be the same as who owns the loan. And commonly they're not the same as who owns the loan. If your mortgage statement comes from Bank of America, might be a portfolio loan, Bank of America owns it. More than likely, they service it for somebody else. FHA, Fannie Mae, Freddie Mac, some private conventional investor, whatever. But the first thing we need to know is who's the servicer? Where does the mortgage statement come from? What's the loan number? These are the pieces of information we need for the homeowner to properly fill out a third-party authorization so that we can send that to the bank, get authorization on file for the bank to talk to me. How many other liens are on title? So we need to do some title research. Here in the Northeast, this is not typically done at all in a regular sale until the buyer's loan's approved and then they're getting their title search done. That's far too late in a short sale transaction. If you've already negotiated a short sale with a lender and we're oblivious to other liens on title, you have short sale approval and then some other liens come up on the buyer's title search, your whole deal's dead. All that was done previously has been a waste of time. Has to be renegotiated unless the seller's got money to come to the table to pay whatever these other liens are. If there's something that we need to get included, try to get negotiated where they're paid through the sale, you got to go back and do the negotiations all over with the mortgage company. And now nobody's happy. Buyer already thought they had approval, already spent money on inspections and appraisal and whatnot. They thought they were ready to close. You're not even close to being ready to close because you didn't have all the information. Because we do title on the buyer side and it's done so late in the transaction here in the Northeast, which is different from most of the rest of the country where it's done on the buyer side, it gets done very late. So we have to take it upon ourselves to look at title. Now, most towns in Connecticut Title's available online. You can at least see the index and get an idea of what's not been released. And then if you need to look further by getting copies from the town hall or something, at least we know to do that and do that further research. There still are some towns though that aren't even online. But that's information that we need to find at the beginning, again, to confirm who's on the deed, who's on the mortgage, are there other liens that we need to get cleared, negotiated? Are there prior mortgages that were refinanced that were never released, that releases are missing for? All those types of things. What's the financial situation for the homeowner? Do they actually have a hardship? Are they going to qualify for a short sale? We got to look at that. Does it make sense to blindly plow forward when it's clear that that homeowner does not qualify for a short sale? I don't see that scenario that often, but we want to look into it to avoid that. Buyer side's really not happy if they're being told, oh, the homeowner was not approved for a short sale after it's been marketed on the property and you've gone through a couple months of review. So what type of mortgage are we dealing with? So let's say Bank of America is servicing it. Well, do they own it? Or is it an FHA loan, a VA loan, USDA, Fannie Mae, Freddie Mac, private conventional, home equity line of credit, reverse mortgage? We need to know what it is. Each one of those has different rules, different guidelines, different policies and procedures for a short sale or any other workout. So once we know who the servicer is and then we find out from them what kind of loan it is, I know what rules apply. I know what paperwork's required. I know what process we have to go through. Has a foreclosure started? If there's a foreclosure next month, it'd be really good to know. I literally got a call just yesterday from a homeowner who got my name from a prior client. They moved out of state like 3 years ago, living in Texas now. Don't know why they haven't done anything in 3 years. Gave me a call. I looked up their situation, asked them if they were in foreclosure. They said they didn't think so. Got the proper spelling of their name, went to the judicial court website, looked it up. Their foreclosure was completed at the beginning of March. They had no idea they were even in foreclosure. That's not that uncommon. That homeowner had no clue they were in foreclosure or that there was a foreclosure date set. Not only was a foreclosure date set, there was foreclosure date set at the beginning of last year that had been postponed due to COVID. So they've had several foreclosure dates, but it was completed March 1st, I think it was. Nothing we can do for them. They are no longer the owner of that home. They've been foreclosed already. So we got to look into that. Where are we at? What's the foreclosure date if there is one? Standard industry policy is that if we don't get the lender a completed application with a contract more than 37 days before a foreclosure, they're not even going to look at it. So if there's already a foreclosure date set that soon, we got to see what the homeowner can do to ask the court to postpone in order to give us enough time for the bank to be required to look at that offer. So Kathy was asking, were they still occupying the property? No, they had moved to Texas a few years ago, which is actually why they didn't know they were in foreclosure. In Connecticut, when they start the foreclosure, you have to be served by a state marshal with a copy of the foreclosure complaint. They don't have to find you in person and put it in your hand like you see on television. They have to deliver it to your registered address. The bank still had the property address as the registered address. So that paperwork's probably like between the storm door and the front door, been getting weathered for the last couple of years. Homeowners haven't been back to the property. They have no idea that the foreclosure had started. So is there a foreclosure date? Have they rented the property? So if these people that I was just talking about had moved and rented the property and their loan was an FHA loan, that's a big problem. FHA has huge issues with non-owner occupied properties when you're asking for a short sale, and especially if they've been rented over 18 months. If you have a private mortgage, private conventional mortgage, so not Fannie Mae, not Freddie Mac, and you have mortgage insurance on it, they also have a big problem if the property's been rented. You're less likely to get approval, or if you do get approval, more likely they're going to want something from the homeowner, like cash contribution or a promissory note, where they agree to make payments after closing for part of the loss for a little bit. But those are scenarios we want to know up front, so we know if those are hurdles that we're going to have, and we can talk to the homeowner about it so they're not surprised if we get into those types of negotiations. We've explained to them which rules apply in their situation. Are they able to maintain homeowners association dues and utilities, stuff like that? You know, HOA dues, municipal water and sewer, those are fees that have to be paid at closing. If they're not going to be able to pay them, we need to know that those bills are going to continue to rise up till the date of closing so we can try to get them paid for and included in the sale of the property as closing costs. Things like utilities, you're going to want to know if they're not going to be able to maintain the utilities, especially if it's going into cold weather, because we have to worry about burst pipes and those types of things. And then has the seller completed bankruptcy? Are they currently in bankruptcy? Are they about to file bankruptcy? All those make a difference because whether they've done bankruptcy or not impacts their standing with the bank. And if they're in bankruptcy or they're going to be filing bankruptcy, oftentimes the bank won't talk to us while they're in bankruptcy. So if we start the process and then they file, the file gets shut down at the bank and we wasted time doing anything. If they are currently in bankruptcy, we have to find out from the bank if they're willing and able to review a short sale while the homeowner's in bankruptcy. So next couple slides are specific tips for agents working on short sales. Some of the stuff's redundant once we get into the contract. The banks are much more specific, dot your I, cross your T as far as the paperwork than you will see on your normal sales. So when you fill out a listing, or when you're taking a listing, the sale must be a 100% arm's length transaction, which means no one in this transaction can be related to the seller. The listing agent cannot be a relative of the seller. It's not an arm's length transaction. The short sale will be denied because it's not arm's length. The buyer cannot be related at all to the seller. The buyer's agent cannot be related at all to the seller. The closing attorney cannot be related to the seller. All these people that are either going to be gaining the property or being paid somehow through the transaction cannot be related to the seller, or the lender doesn't consider it to be arm's length and they will not approve. And the seller can't be their own agent. If they happen to be a realtor, they can't list their own property for short sale. They won't allow it. They believe that there's more likely to be some kind of fraud or collusion or something like that involved. So they just won't approve of it. So when you're filling out the listing agreement, fill it out as completely as possible. Typed is preferred. You know, we need to have as clear a copy as possible after it's all signed off on to send to the bank. If they can't read part of it, they're just going to kick it back and they're going to ask for a new copy to be done, which just wastes time. Anything that's crossed out has to be initialed by the agent and the seller. If you're leaving blank lines, ideally put like NA in the line. If you're using a pre-printed listing agreement and you're filling in all the blanks by hand and it's signed by hand, you should be fine. If most of it is typed and even the fill in the blanks part you typed, but then a couple things are handwritten in, the bank's going to ask for those to be initialed by both parties because they don't know when that was added. It could have been weeks after the fact. So if you like pre-fill out your listing agreement except for the list price until you sit down with the seller and then you fill that in by hand, make sure you both initial it because the bank will kick it back. E-signatures are accepted by most servicers, but not by all. Bank of America is a big one that does not accept e-signatures on short sale documents. So if you're working with us, we're going to find out who the bank is at the beginning, and we're going to let you know whether e-signatures are accepted or not. For those that do accept it, obviously e-signatures are great because you typically have a much cleaner copy of the contract. Commission is negotiable with the servicer. Typically, you're going to want to start with 6. That's the max we ever see approved. About 90% of the time, we can get them to approve 6%, but there are some that aren't going to approve more than 5. Webster Bank's a big one locally. If they own the loan, 5% is the max that they'll approve. If they own the loan, but they also service FHA, Fannie Mae, and Freddie Mac loans where they can't cut below 6. So just because it's Webster doesn't mean we can't get 6 approved. Depends on who owns the loan. Who owns the loan is actually the very first question that we ask the bank. Once they say, yes, we have your authorization on file, we can talk to you, because it's so critical. Everything goes from who owns the loan. All the rules come from that. You want to state on the MLS how commission reductions will be split. Now you need to talk with your office manager and find out what your company policy is on this. But the MLS does allow for you to put a commission percentage. And then in a short sale scenario where you've checked the box that says short sale, list how any possible reductions in that commission that are required by the lender will be handled. So for example, you can check the box that says short sale, which opens the short sale comments section, which is where the MLS wants you to put this information. And you can put something along the lines of any reduction in commission required by the lender will be split 50-50. So if you're offering 2.5% and they cut commission by 1%, you've already disclosed that you're each going to take 0.5% less because the bank cut commission by 1%. I'd recommend also putting that language into agent to agent remarks field because agents are used to looking there. It's right below the public remarks. Short sale comments is much higher up on the sheet and it only opens when it's a short sale. It could be missed. And if that scenario does happen, it'd be preferable that you're not trying to go back and point out to the agent that it was there and they missed it the first time. If you put into agent remarks, it's unlikely that they missed it to begin with. But some companies still go by the old, we're only going to list it for $1 co-broke thing. So you need to check with your company policy and go by that. When you're pricing it for the list price, base it on current market value. If they owe 50 grand more than that thing's ever going to sell for, it doesn't make any sense to start at what they owe. You're just going to sit on the market for a while, not get any offers, have to reduce the price several times, or reduce it by large amounts in order to get to where you need to be to get an offer. Ideally, you want to list it at something around like the higher end of what you think the comps suggest it would actually sell for. So if you do a CMA and you come back with, hey, this looks like it's going to sell between like 250 and 270, started at like 269.9. It's a short sale, so it's probably not going to sell at the high end of the market. Although in the current market, who the heck knows? Because weird things are happening. But under normal circumstances, short sales don't sell at the high end of the market, but you're giving the homeowner the benefit of the doubt that they may get the highest that they can get. But be prepared for after about 2 to 3 weeks to make a price adjustment. In that scenario, $10,000, $15,000 would be a reasonable price adjustment. And then hopefully that would be enough for you to get an offer. That has established a little bit of what the property won't sell for us to show the bank. And again, you don't want to start too low and then you get, prevent yourself from getting higher offers. Give yourself the benefit of the doubt. List it definitely at the higher end of what you think it realistically could sell for, unless there's no time. If there's a foreclosure date like 60 days out, we don't have time for that. You have to list it like really right where you think it needs to be to sell, get an offer right away, because we don't have time to waste, because the bank's only going to look at the offer if we get it to them more than 37 days before the foreclosure date. And those are things that we talk about with the agent. Ask us those questions. What should I list it for? Where should I list it? I'm going to ask you what you think the value is, and we're going to go back and forth to determine, hey, what's it look like the best situation is given the current circumstances, when there's a foreclosure date, if there's a foreclosure date, what the market looks like, that kind of stuff. But definitely don't leave it on the market at any one price for an extended period of time if you're not getting offers, especially in the current market. 3-4 weeks max, time to make a price adjustment, because if you didn't have an offer already, it's just not at the right price. For your listing agreement expiration, I usually recommend at least 6 months. Most short sales take about 90 days to go through the process with the bank to get short sale approval. FHA loans are usually 30 days longer than that, so like 120 days. But if you say it takes 30 days to get an offer and then 90 days to get short sale approval, you're already at 4 months. If the buyer's getting FHA financing, you're at another 6 weeks. You're coming up within like 2 weeks of when your listing expires. And the lender on the short sale side is going to require that your listing does not expire prior to when we close. So that's why I say 6-month minimum. Ideally 12 months, because then you don't have to worry about the listing expiration at all for quite a while. If it takes a while to get an offer, or if we get an offer and then the buyer backs out and you have to get another offer and that extends the timeline, you're not worrying about doing extensions. But anything less than 6 months, you will absolutely have to do an extension at some point. I already talked about don't let it sit, reevaluate at least once a month, and be aware that vacant properties may be secured, which means the bank's going to come in, they're going to break in, they're going to change the locks, they're going to winterize the property, even though it hasn't been foreclosed on yet. If the property's vacant and the loan's not being paid, that's going to happen at some point. Happens less often in warm weather. In the cold weather, it happens very, very commonly. And just be aware that that can potentially happen if your listing is vacant. I don't recommend using an e-lockbox on a short sale that's vacant, because these people will break your box trying to break into the house or throw it away or whatever, and you may not get it back, or it may be broken. So use a cheapo box if it's vacant. And it's, the homeowner's not making the mortgage payments, just so you don't lose quite a bit of money with an electronic lockbox. They will give us their lockbox code once they've secured it, because they don't own the property. They have to provide us access, but they typically do not give you forewarning that they're going to come out and do this. So contract tips, a lot of the same type of stuff. Buyer can't be related to the seller. Buyer can't be paid a commission to purchase the property. So if the buyer is an agent and they're representing themselves, they need to understand going in, they will not be paid a commission. The short sale lender will not allow the listing agency to pay the buyer a commission when they know the buyer is going to be getting the commission. A couple ways around that: they could have their office manager be their representation, or somebody else on their team or something like that, but they can't represent themselves. And if you end up in a scenario where the bank is saying, hey, we're not going to allow you to pay commission to the buyer side, either because the buyer is their own agent, or that also happens if the buyer agent is related to the buyer, they still feel that it's the buyer being paid. In those scenarios, it's unlikely the bank's going to agree to let the listing agency pay commission. And one of two things is going to happen. They're either going to tell the listing agency they can keep all the commission, but they cannot pay any of it to the buyer side, or they're going to chop the commission in half and keep that portion that would have gone to the buyer side. If the listing agency gets to keep it, the buyer side's really, really, really not happy, because it wasn't cut and the listing agency got to keep what they thought they were going to get. So these are questions we want to ask at the beginning. Hey, buyer, are you your own agent? Hey, agent, are you related to your buyer? So that if this is an issue, we can try to strategize, how can we get around this so that you guys can get paid the commission that you're expecting? And typically that is somebody else has got to be the agent, usually like office manager, broker, or something like that. Fill out the contract completely, typed as preferred, Crossouts have to be initialed by the buyer and the seller. Same stuff as in the listing. E-signatures are accepted by most, but not all. Same as on the listing. Closing date should be on or before 60 days from short sale approval. That language. That satisfies a whole bunch of issues that can pop up during the transaction. The best thing to say is on or before 60 days from short sale approval. If it doesn't fit on the line, see C section, whatever the section is for other conditions on the contract you're using, and then put that language in there. Short sale and as is contingencies are needed. It's best to use riders that explain to both sides what a short sale is, what as is means, but the bank's going to want to see that both of those contingencies are in the contract. Bank's going to require proof of funds from the buyer for 100% of the sales price. So if they're getting financing, they're going to want to see their pre-qual, and then they're going to want to see actual proof of funds from the buyer for the amount that they say they need to bring to closing. So if they say they're bringing 10% down and they're financing 80%, or sorry, 10% down and they're financing 90%, they're going to want to see a pre-qual for the 90%, and they're going to want to see a bank statement that says they have that 10%, or some kind of other kind of proof that they have that 10%. If it's cash, they want proof of funds for all of the money, that they have the cash. If the buyer is asking for a closing cost credit, which is kind of common, and it can be approved on a lot of short sales, depending on who owns the short sale loan. Max is always 3%. You're never going to see more than 3% approved on a short sale. But if they're asking for that, then we're going to have to get from their lender an estimate of the buyer's closing costs, because I need to fill in itemized every single line item figure in the estimate of settlement costs that I have to send to the lender. So we always have to send an itemized estimate of the seller's closing costs. How much is the commission? How much is the closing attorney's fee? How much are the conveyance taxes? All of that stuff. Normally, we're not filling out anything on the buyer's side other than what the purchase price was, except when the buyer's asking for a closing cost credit from the seller, then we have to fill in all of the estimated costs on the buyer's side. Their lender will have this right in their loan origination software, but it's not a common question that they get, but it is something that's required on a short sale. The lender's only going to review one executed contract at a time. They will not review multiple offers, and they will not review multiple executed contracts. There should never be multiple executed contracts. The seller can only sell their property to one buyer. If you get multiple offers, the seller doesn't sign them all and send them to the bank. That's not how it works. We have to work with the seller to determine which offer you think is the best offer, and then that's the one the seller would accept. Maybe you're going back for highest and best, but in the end, we need to decide on one offer that gets signed and is made a contract that's subject to short sale approval. That's what goes to the bank. Anything else will just confuse the crap out of the bank and screw up the file while they're confused. If you get a backup offer after you've already submitted a contract to the bank, it's just a backup offer. Even if it's better, seller's already in contract with a buyer. Unless that buyer backs out or the bank denies that offer, the seller's under contract, just like on a regular sale. Inspections before or after short sale. I have another slide coming up. I could talk more about that. Septic, who's going to pay for pumping? Normal custom is the seller pays for it. If the seller's got no money because they're unemployed, they've been unemployed for months and they don't have the money to pay for that, it's a question you want to ask, and you want to disclose to the buyer side, hey, unlike a regular sale, you're going to be responsible for the pumping because the seller doesn't have the money to do it. Preferably, you want them to know that when they're giving you an offer, before they give you an offer, so that they're offering accordingly, knowing that they're going to have this cost that's not normal, not customary. But we want to have that discussion with the seller. Are they going to have the money to pay that? If the buyer is an LLC, like they're going to rehab the property or something like that, the bank's going to ask for their stamped certified articles of organization. It is the only document they will accept that identifies the LLC as valid, been registered, and who the owners are. And they need to verify that the seller is not an owner of it. But this particular document is the only document they accept. A lot of LLCs won't have it because you have to pay extra to the Secretary of State to get the stamped certified copy back. So they may have to go pay the Secretary of State to get it because they don't already have it in their file. And then do you counter offers, not counter offers, or let the bank counter? Typically, if you have multiple offers, first thing is you're probably going back for highest and best, especially in the current environment. If you don't have multiple offers and you just have an offer and you think the offer is either in line with current value or at least close, probably makes sense to accept it. If you think it's kind of low, then we want to disclose to the buyer side, hey, seller's willing to accept this, provided the seller is. Obviously, we have to talk to the seller. They decide what they accept first. But if we're accepting that and we think it's low, we want to put them on notice that, hey, we think your offer is low. We're going to do everything we can to get the bank to accept it as it is, but don't be surprised if they counter. And now they're set up and they have the right expectations that if we get it, we may get a counter from the bank, because it's going to take till near the end of the process to get that counter, 60 to 90 days, typically. So we want them to be on notice so they're not surprised. and then it's coming from the bank. But if you have offers that are like stupid low and you're like, there's no way we can justify this as being current market value, this is never going to fly. In that scenario, it makes sense to counter the buyer, because it doesn't make sense to waste time with an offer you know for sure is never going to fly. Hopefully they'll at least come up into a realistic range, or you just don't accept that and you leave it on the market looking for a more realistic offer. Because again, the bank's going to do their own value. So if the comps don't justify that price, the bank's not going to accept that price. What we want to avoid, especially when the buyer is not a company, when it's a person, a buyer who's intending to live in the property, is that they get countered multiple times. We don't really want to counter them at the beginning. And then if the bank counters them again later because their value came in higher, they're more likely to back out just because of the emotions of it, because they've been countered 2 times. They feel like they've already gone through this. Now they've been asked to wait months and now they're getting countered again. They walk away. That's why it's better to just set them up if we think we're at least in range and say, don't be surprised if we get a counter from the bank, but we're going to let the bank make the decision, because then they're just getting countered the one time. And they didn't know, they knew that it was potentially coming. So just some tips if you're working with a buyer working on a short sale. Is the buyer willing to wait? Typically 4 to 6 months for closing. 3 months for short sale approval, of the 30 days or so to close if the buyer's getting financing. If the loan on the seller side is an FHA loan, it's at least 4 months for short sale approval. If there's some uncommon delays or something like that, it's going to be longer than that. If it's somebody else working on it, not us, if it's just an agent working on it, doesn't have a lot of experience, definitely could be longer. Timeframes that I quote are what we can get done. Doesn't mean that everybody can get them done that fast. And I know it doesn't sound like fast, but I get files all the time where somebody's been working on it for a year and they haven't gotten it done yet. And I'm like, you're so far off of what it really should have been. I don't know what's happened, but something's not right. Let's get you on track. But is the buyer willing to wait? You're going to want to find out what's the expectation of how long this is going to take. Ask those questions to the seller side. And based on the answers, you may not have a great feeling about them not knowing what the heck's going on. If they really can't give you any kind of information. Again, short selling as is, those are going to be contingencies that have to be in the contract. The bank's not going to make repairs. And in most cases on a short sale, seller doesn't have any money to make repairs. So if you know that this property needs repairs, especially if the buyer's getting financing that's going to require those repairs be done, you want to address that either before you're putting in an offer in or when you're putting an offer in. Because if the seller's not going to be able to make those repairs, the bank's not going to do it. And your deal's just going to fall apart, even if the offer gets accepted, because the buyer's lender's not going to approve the house. Really talking about FHA and VA loans. Which goes on to number 3. Will the property pass for the type of financing the buyer's getting? Inspections now or after the short sale. There's one more slide. Talked about that whole thing. So we'll get to that. Again, septic, who's going to pay for it? Seller might not have the money. Did the buyer need any closing costs? They may be possible, but not always. 3% again is always going to be the max. Who's negotiating the short sale for the seller? Is it an agent, an attorney, a negotiator like us? Is the seller trying to do it themselves? If you're on the buyer side, you probably want to know the answers to that to have realistic expectations as to whether it looks like this transaction's, set up for success. Is somebody working on it that's got experience working on it. Even if it's the agent, if the agent's done a bunch of short sales, great. If they've never done one and they're the one working on it, the bank's not going to walk them through it. So that's the information you would want for your buyer to be able to advise your buyer. Is the property vacant? Is it already winterized? If it's vacant, just keep in mind that if it's vacant, it has been winterized. It very well could be at some point. And then if it does get winterized and the utilities are off, who's going to turn those back on for inspections and appraisal? A lot of times the seller wasn't paying those because they didn't have the money to pay for them. They don't have the money to get them turned back on either. And the bank's not going to pay to turn anything on. They don't own the house. It's not their house. And is the buyer agent related to the buyer? Because we talked about that with the commission situation. And then reasons to consider inspections first. The norm in Connecticut is not that inspections are done up front. Typically, the buyers do inspections after you have short sale approval. But there are a bunch of reasons for the seller that it makes sense for the buyer to do them up front. And there are a bunch of reasons for the buyer to do them up front too. So it doesn't waste time waiting for approval on a house that the buyer doesn't want to buy. If there's any concerns about the condition of the property and the buyer might not want to move forward, they're better off getting that out of the way now than waiting 3 months for short sale approval and then finding out they don't want to move forward with the sale anyway, especially now where interest rates are low, but they're going back up and inventory is really low. The perfect house for that buyer might go to somebody else in the meantime while you're waiting for short sale approval. And then the buyer determines that they don't want to move forward. If it's a newer home and you're less concerned, well, then that makes less sense. But if it's an older home and you're like, we don't know how things are going to come out in the home inspection, based on what we're seeing, we're a little concerned, makes more sense to do the inspection up front. Renegotiating with the seller after inspections and before the bank has seen the offer is your best strategy. So like in our office, if we're told that the buyer's doing inspections first, we're working on getting all of the financials that we need from the homeowner, the pay stubs, the bank statements, the tax returns, putting the whole package together, but we're not submitting it to the bank until we hear that we've cleared inspections. So that if the buyer does inspections and finds out there's something big wrong that they weren't aware of, they're still willing to move forward, but they're going to have to pay to make that repair themselves. So they want to lower their offer, that we get a new contract done before we send it to the bank. So we're not sending the bank an unrealistic expectation of the sales price of this property. And now we have the inspection information to justify to them why the value is reduced when they do their value. So you have a better chance of success versus you get approval, then the buyer does inspections and they find something wrong. The bank's already done their value and that information wasn't taken into account. It's less likely that they take the whole thing properly into account when you're trying to go back and renegotiate and say, hey, stuff came up in the inspection. If you had the information at the beginning, your chances of success were much higher because you have inspection reports and potentially, contractor quotes and that type of thing to be able to present to the bank and to their appraiser or BPO agent when they come out, so that they hopefully support the buyer's, offer. Interest rates may be rising again. So if the interest rates go up 0.5% in the next 3 months while we're waiting, the buyer is going to qualify for less money in 3 months, and it's going to cost them more in a monthly payment for the same purchase price. So knowing that they want to move forward with the transaction for sure sooner rather than later is actually in the buyer's best interest. It's worth the money for the inspection. I already talked about renegotiating the price after you've already gotten approval is much less likely to be successful. And basically it's an investment that increases your chances of buying the home at the price the buyer wants to pay if you have all of that information before you go forward. Even if you don't find anything majorly wrong with it and you're not adjusting the purchase price, having the inspection report to give to the appraiser to point out anything that did show up wrong, because there's always something wrong, even if it's minor. The more things there are, the more likely it is we can get them not to think this place is the Taj Mahal when they're doing the value and submitting it to the bank. Now, from the seller's perspective, it's always better if the buyer would do the inspections up front. Because if they're going to walk away, the sooner they walk away, the better for the homeowner. They're not wasting all of this time getting closer and closer and closer to foreclosure for a buyer who's never going to make it to closing. In addition, if there are issues again that need to be rectified, if the homeowner has the ability to make some minor repairs, they've got more time to do it and get it done and get the money together to do it. Like scraping for chipping paint and stuff like that. Instead of that popping up on the buyer's, inspections and stuff when you've only got 30 days or so to close, you're much earlier in the transaction. So those are just suggestions, reasons. Again, the norm is the buyer doesn't do inspections up front, although I do see it more common these days than I used to, because there's more reasons for it to be in the buyer's best interest to do it. Used to not really be that way at all when the market sucked and, you're lucky if you ever found a buyer for your short sale. So that's it. That's the full presentation. That's about half of the 3-hour continuing education class that I do. If you guys have any questions, you can unmute yourself or put it in the chat. Happy to answer any questions that you have.
Sean, I thought that was great. I had a question. Do you find a certain percentage of short sales, or do you have like a percentage of the overage or the difference in the loan amount versus the
what's worth?
Right.
It varies a ton. It really does. There's no
like 25%, 30%.
And the bank doesn't look at it that way at all. The only thing they care, it's really a 2-part review. First part is homeowners' financials. Are they eligible for a short sale? Mm-hmm. Then it's what's the current value of the property? What kind of offers are we getting? So you can have it only be $10,000 or $20,000 short. You can have it be $200,000, $300,000, $500,000 short. That doesn't really make a difference to the bank, because once they acknowledge that they're going to take a loss and have to foreclose if they do nothing, then the only thing that matters is what's the most we can get from the property given its current value. However much the loss is, it is. They're either going to take it in a short sale or you're going to take it and probably more when they foreclose. Reverse mortgages, we most commonly see well over $100,000 difference in the value and what's owed. If the person bought it like 5 years ago with a low down payment loan and they've just started being delinquent, it's probably much smaller, $10,000, $15,000, $20,000.
Right.
But yeah, not really an average. Let's see. Kim's asking, what areas do we service? We do all of Connecticut. We also do Massachusetts. We do some in New York, but New York's a whole different ballgame. There's more things that have to be done in New York. So that's kind of case by case. Title information, where the foreclosure is at, is much more difficult to ascertain. So in New York, we need to have a prelim title search done and given to us so that we know who we need to negotiate with. Connecticut, we can easily find that information online. The foreclosure website's very easy to navigate if you know what you're looking at, so we can figure out where they're at. Massachusetts, title information is really easy, but foreclosure is impossible to know where it's at in the foreclosure process. It's not nearly as open and accessible to the public to figure out where it's at, whether there's a foreclosure date. Let's see, Sally, are the rules the same in most states? So the short sale guidelines are the same regardless, because it's pretty much national banks that we're dealing with. So whether the homeowner qualifies and all that kind of stuff, the foreclosure process, collections laws, foreclosure laws, that differs from state to state. So like here in Connecticut, where we're a full deficiency state, and the bank can come after you after foreclosure for money, even if they already foreclosed, if there's still a loss, that is different in different states. In Florida, if it's your homestead, they can't come after a deficiency. Same thing in California. So there's certain states where the repercussions of foreclosure are less than they are here in Connecticut. But there's also a lot of states that are non-judicial states where the foreclosure doesn't go through the court system, and they can literally foreclose on you in like 3 to 4 weeks from your first missed payment. So vastly different foreclosure process. And then obviously the closing of the transaction is different from state to state. What's customary closing costs for the seller, is different in Connecticut than it is in a lot of other states. Where I talked about earlier, a lot of the states outside of New England, they use title companies, not closing attorneys. And so title or escrow companies, and title is done on the seller side. The seller pays for the title insurance policy. So that's a cost on the seller side. Whereas here, it's not a cost on the seller side, it's a cost on the buyer side. The reason that's important is in a short sale, we're trying to get the bank to agree to let the property sell for the contract sales price you have and cover all of the seller's closing costs from the sales proceeds. So if we're not including some fee that the seller's going to have in those figures, the bank's not going to agree to pay for it because we never asked them to. So you have to know the standard closing procedures. Like when we work in Massachusetts, there's some towns in Mass that are weird. Their gas and electric is a municipal utility. So here we have municipal utilities are like water and sewer. In Hartford area, MDC. A lot of other areas, it's town or city specific. But the water and the sewer is municipal, and since it's municipal, it's an automatic superior lien on title. So they have to get the final reading, and it's that final bill has to be paid at closing for the title insurance to be satisfied that there's not a possibility of a lien for that the buyer is going to be inheriting. Well, there's some towns in Massachusetts, we have the same thing for gas and electric. So you have to get in touch with the gas and electric company to figure out, is the bill current? What's the average bill? So we're estimating what's going to be due at closing. So those are the types of things that would change from location to location. But the guidelines that come from the lender as to what they'll approve, whether the homeowner qualifies, that all is the same nationwide. We could technically negotiate short sales all over the country. The problem would be getting familiar enough with the closing procedures, the seller's closing costs, and that type of thing, as well as the foreclosure proceedings, how to find out how close we are and dates and whether they can be postponed and those types of things that are beneficial for us to have. So we really have a full grasp on what's going on. And then every state's different when it comes to licensing. The only reason we do Mass and New York is because they don't actually require any licensing. Here in Connecticut, the license we have to follow all those guidelines, but we can also do Massachusetts. We can also do New York because nothing additional is required. We don't do Rhode Island because they have a completely different license required there. They consider it a totally different industry outside of mortgage. So it's never really made sense for us to get licensed there and go through a separate hassle. But it's like that for a lot of different states. Now, if you were doing your own as an agent, most states you're exempt from having to have any kind of licensing as long as you're not being paid more than a commission and you're not actually negotiating terms with the lender, like cash contributions for the seller or promissory notes. If you can just send them paperwork and they do their value and they say, yep, we'll accept your offer, then you're exempt. If you get outside of that when it comes to terms for the seller, then in many states where there are exemptions for a licensing requirement, you end up outside of those lines. Let's see, another question.
Thank you.
Sure. If the seller has hired a company like yours, should the buyer side have someone like you as well? This may be obvious, haven't done a short sale yet. So that's not really common. There isn't anything that we can do for the buyer because it's the seller's debt that's being negotiated when you're negotiating the short sale. I've had agents, and I tell agents all the time, like if you have a buyer and you're looking at a potential short sale and it's not one, if it is one we're working on, feel free to give me a call. I can answer any questions you have. If it's not one that we're working on, give me a call. I can look up, see if it's in foreclosure, see what the title information looks like. It usually only takes a couple of minutes on the internet to look that stuff up and give you some background as to what's, what you're dealing with, and maybe some educated questions to ask the listing side. I've had buyer's agents request or suggest that the listing agency hire us to do the debt negotiation when their buyer is putting in an offer. And typically, if they hadn't already hired us, it's either because they think that they can do it themselves, or they just haven't heard of us. I have a very good reputation, but not every agent in the whole state knows who I am. But getting them third-party verification from somebody they trust shouldn't be a problem, because I've worked with like every brokerage in the state practically, except for a lot of mom and pops. So even if it's like from an office manager in a different office because they're in a part of the state that I haven't worked in before, we can get them third-party verification. And the reason I say that is they're typically not going to take the word of the buyer's agent. Like, oh, I really like this guy. Can you use them? They'd rather hear it from somebody that they already know and trust. Oh yeah, absolutely. Like Berkshire Hathaway, for instance, I've had a really good relationship with their corporate attorney for a long time because he used to be the Connecticut Association of Realtors corporate attorney. So, I mean, they could go up to the company attorney and get third-party verification, as well as, many, many different offices. So that type of thing, we can always get involved, but the buyer or the seller side has to be willing to bring us on board. I mean, I am privy to all of the seller's financials, their social security number, their pay stubs, bank statements, tax returns, you name it. So they have to be 100% on board with hiring us because it's their best interest that we have to look after first. I mean, the only thing that we're really doing for the buyer is we're trying to get this deal approved and get it closed. So we're really working almost as a transaction management in that we're trying to do everything possible to get the deal approved and get it closed. But we also have to primarily be looking after the seller's best interest. The seller's best interest is getting the debt forgiven if the short sale is approved. That doesn't really affect the buyer any, but sometimes the process might take a little longer. The bank didn't initially agree to forgive the deficiency, so we're doing extra negotiations back and forth between them and the seller, with maybe the seller's going to offer a little bit of money as a cash settlement at closing so that they'll forgive the remaining balance. And I see that more often these days than we used to, since the whole home affordable program expired in 2016. So, those are things where we're going, yeah, we already have technically short sale approval, but there's more work to be done to make sure we're getting the best outcome for the seller, because they're the ones who are having a problem, and hopefully we're getting our work done to the fullest extent where that problem is going to be 100% gone when we close.
Thank you.
You're welcome. Anybody else have any other questions?
I thought this was excellent. I apparently there was a glitch with the link, and so this is being recorded. I will send it out to everyone that registered. We had 24 registered, so I feel bad that got messed up, but technology, we're all learning.
And I'm happy to answer questions. So they can review the recording, and if they have questions, they can reach out to me, phone, email, whatever.
And I thought this was great. And I'd like everyone to kind of think about what you've learned. You heard so many terms today, and I'm sitting here saying, I've been doing this for 35 years and I know exactly what he's talking about. And I'm wondering if you don't, we should have another class just on the mortgage side part of it, because there's so much there to know too. So.
Yeah. And there's a whole other section that I couldn't include due to time. That's in the CE class that I teach, where I talk more about like the servicers and the investors that own the loan and mortgage insurance and the terminology and all that kind of stuff.
And the government loans versus conventional versus, USDA. There's a lot of information that as a realtor, you may not use it, but you may need it, and you'll have, at least a recollection of what you should be looking for. So we'll do that. We'll put that together. Sean, you might be one to help us with that. That would be great.
Sure. Absolutely.
Anybody else have any questions? I appreciate you all coming, and Sean, thank you very much. I do think that we will do this again. This will be put on our workplace site for Connecticut, so you'll have, more exposure there too.
Great, sounds good.
Great, thank you so much. All right, bye-bye.
Bye-bye.